In this chapter, we'll use ratio analysis to compare the performance of the company over time and to compare performance to companies in the same industry, as reported by the member banks in the Risk Management Association. 5 ratios provide a framework to understand the company. Profitability ratios will help us consider the company's profits relative to a given level of sales, a certain level of assets, and the owner's investment. Activity ratios will discuss the speed with which various accounts are converted into cash. Market ratios measure the value of the company's future earnings to a hypothetical buyer in a fair market context. Debt ratios consider how the cash flows support the assumed acquisition financing. Liquidity ratios for the new company show the ending cash balance for each week in the first year compared to the target cash balance. These will be some of the most important discussions. We begin with considering the composition of revenue over time in each fiscal year and year-to-date period. Revenue change and growth reflect year-over-year performance. We can consider the seasonality of revenues in the fiscal year and the distribution of revenue among clients. Gross profit margin measures the percentage of each sales dollar remaining after the firm has paid for its goods. Operating profit margin measures the percentage of each sales dollar remaining after all costs and expenses other than interest and taxes are deducted. These are the pure profits earned on each sales dollar. Average collection period indicates the average amount of time needed to collect accounts receivable. Average age of inventory measures the average number of days sales in inventory. The average payment period shows the average amount of time needed to pay accounts payable. The cash conversion cycle indicates the amount of time a firm's resources are tied up to then generate cash. The operating cycle is the time from the beginning of the production process to the collection of cash from the sale of the finished product. This is calculated by adding the average age of inventory and the average collection period. We then subtract the average payment period from the operating cycle to get the cash conversion cycle. This information will be helpful when we develop the forecast balance sheet and the cash forecast for the new company. Total asset turnover indicates the efficiency with which the firm uses assets to generate sales. Return on assets measures the overall effectiveness of management in generating profits with its available assets. In this chapter, we considered the normalized performance of the existing company in the historical periods and compared to comparable companies. Profitability and activity ratios help us understand the key drivers of business operations. For more information, contact Rainier Business Intelligence.